and I wanted to talk about this as well. A little talk on expectancy. Similar to what we're talking about with sort of the spread positions, but what is profit expectancy, and do spreads meet it? This was a direct question from Ron. Question regarding expectancy. When I look at the power options displays on possible trades, for example, bull put vertical spreads, I make an approximation of what statistically should be my return over the long term. I compare the trades thusly. Percent probability times the maximum gain minus 1 minus the probability times the maximum loss equals the expectancy or expected net over time. Negative expected net means the casino is going to get me eventually. I realize this is an incomplete comparison because it does not consider the between the spread returns and so forth. But he wanted to know, is this general approach something you would always consider valid? And if so, is this expected net available on power options displays? Now, on power options, we do not have a direct filter or column that shows the calculation for expectancy in that manner. We show the probability, we show the returns and so forth. We don't show the expectancy. Many investors do use the expectancy and usually get disappointed with the idea of credit spreads because they never seem to come out as a winner. Some may point out that using lower probability, say a 70% with a 30% return as opposed to an 85 or 90% probability with a 15 or 10% return, will have a better expectancy and positive return. But all of our testing over the past 6 years has not showed that. You don't get more success over time looking for the lower probability with the higher returns unless you're in a raging bear or raging bull market and you're using the proper structure for that current sentiment. Now, the preferred search and power options for bull puts is the weekly bull put search. We're looking for a minimum probability above 85% that the spread will expire worthless. Average return around 15% over time. This will give a negative expectancy. And this is why we discuss, and as Jim mentioned, and as Chuck mentioned last week when doing spread positions, trade management is key. Any video we've ever done that discusses credit spreads, debit spreads, or in the money debit spreads specifically, but also the at or out of the money debit spreads, it is suggested, recommended, and important that you close the position if you hit 50% of its maximum loss on the trade, as well as other triggers you might use to modify or make adjustments or roll the position. In any structure of a vertical spread where you're looking for 90% probabilities, 85% probabilities, 75% probabilities, or even lower, if you're looking for those as well, you cannot allow the position to go to a 70, 80, or 90% loss on the position. It's going to wipe out too many gains, and you'll never see positive expectancy with this kind of structure. Let's take a look at that in a little more detail, but with less words. These are the results from 3:37 p.m. Eastern Time today on the 20-minute delayed service for the weekly bull put credit spreads. The highlighted area here is what we've essentially seen up until about the beginning of 2022, from about 2016 to 2022. These positions here with about an 85, 86% probability with a return of about 15.7 to 14.3%. So an average probably right around 15% return with about an 86% success rate. And that's what we've seen in both trading and historical testing over time with the structures that we use. Let's take this Costco position and see, is it even worth it as expectancy goes? Let me go back one. I'm sorry. Let's do that a little bit better. Sorry, folks. On the Costco position, let's just change a pen color here. There we go. The stock's at 528.21. We're going to sell the 5th of August, 14-day out, 500 strike put for midpoint price somewhere between 270 and 290. And we're going to buy the August 497.50, a 2.5 point spread, and we're going to look for a net credit of around 34 or 35 cents. This has an 85.5% probability of success, maximum risk of 216 for a 15.7% return. So these two numbers here are maximum net credit, the maximum return, and the maximum loss are what would be considered in the expectancy equation that Ron mentioned. So naturally, what would we have? Well, we've got an 85.5% probability. We place 100 trades. 85.5% of the time we make 34 cents. We take in $29.07 of premium. Of those 100 trades, 14.5, we lose $2.16, which puts us at 31.32. What do we get? We get a negative expectancy, chance of loss of minus $2.25 for losing scenario. And that is where the management comes in, because no one I know that trades spreads of any kind lets it get anywhere near that 100% loss level. It's always going to be closed early, whether you close it at 40% loss, or maybe 3 times the net credit, or at a 50% loss is what we usually recommend in these scenarios. That's what you're going to look for. And in that scenario, what do we have? Still have an 85.5% success rate. At 34 cents, we get 29.07. But now, 14.5 losses out of 100 trades, but we're going to cut them short at 50%, so we only lose 108. So that's $15.66. Now we're at a positive expectancy of $13.41. Yeah, never allow a spread or a leverage trade to reach near 100% loss if possible. Use triggers such as the 1% rule. The stock reaches within 1% of your short option strike price in a credit or debit spread, or you're right at a 50% loss of the position. Just liquidate it. Don't allow it to go to a 60, 65, 70, 90% loss. Don't hold and hope. Manage it. Management is the most important thing for these types of spread trades the trend is also extremely important, following the trend, as Jim mentioned in that case, as well as the proper structure. But management is also key. Don't trade spreads around known events such as earnings, where a surprise can suddenly shoot against you, and before you can stop it, before you can close it, you're at a 70, 80, 90% loss. This applies to iron condors as well, even if you're using that 85, 90% probability between. Now, what did I mean by that 70-30 comment, where I said some may point out that using a lower probability of 70%, where you can get a higher return of 30%, might yield a better expectancy and positive return over time. However, all of our testing over the last 6 years didn't really give us that case. I changed the criteria, kept the same technical and fundamental indicators on the bull put search, but I put the probability just to be greater than 70 and the percent return to be greater than 30. Let's take a look at Blackstone here at 96.82. We're going to be selling the August 92 strike, not too far out of the money. It's only about 4%, 4.5% out of the money. And we're going to buy the 90, a 2-point spread. Now, we're going to get a high net credit of about 49 or 50 cents at midpoint for a risk of 152, 151. And a 32% return with a 72% probability above. So this is a slightly different structure, less out of the money, lower probability, much higher return. The expectancy in this case, 72.8% of the time we make 49 cents. Well, we've got 35.67 in. The other 27.2% of the time, we lose $1.52. That's at 41.34. This is actually a lower negative expectancy of $5.67 as opposed to the 2.25 we saw with the 85 and 15. If you also apply the 50% loss rule here, you would have a winner. But part of the testing showed us that with these positions that are only 4 or 5%, 3 or 4% out of the money on a 14, 15-day trade, with a 70 to 75% probability, when the market turns, it is so much harder to get out at the 50% loss. When the quick turn happens, you're usually already down 65 to 70% because you were so close to the money in that situation. And that's where the problem came in, is that we weren't seeing as much success rate with those higher returns and higher probabilities in those cases because of that scenario. Okay, and I've got a comment here that we're going to address in a moment here, and that's from Victor. But let's do this first. We're going to take an illustration of this in the trade simulator to show just how quickly it goes against you. And then, Victor, I'm going to answer your question as well. Now, let's go ahead and pause the screen. We'll navigate over to radioactive trading. And let's move this here. All right. There we go. Perfect. All right. So here I am at radioactivetrading.com. And what we're going to do here is go to Resources, and we're going to click on the Trade Simulator tool. Now, the Trade Simulator tool was designed initially to reinforce the positive expectancy concepts of the married put position, which it does over covered calls and other similar strategies. But we can use this to illustrate what I was talking about as well. the structures that I mentioned with the weekly bull puts. Now, I'm not saying to trade weekly bull puts. That's the preferred search if the market is going in the proper direction. Market hasn't been going in the proper direction for when we would trade that strategy. You heard me say that oftentimes in the past 7 months. But again, what would I be looking for? Average return was 14.9%. We kept the losses down to 49.8% when our triggers were hit. And the probability of loss, that's only, 16%, no, 14%. It was about an 86% success rate. Now, let's say I took a $10,000 account and opened 3 trades each cycle, looking to make 14.9% when I'm right, controlling my losses to 49.8% when I'm wrong with an 86% success rate. Now, 90% is really profitable. 93% is, I'm going to get to the range we want. 88, you're seeing, have a drawdown of 11, 12% over time. There we go. Let's go 84 to 16. So at one point, we did lose about 22%. We're showing strings of winners and losers over time. And those 4 losses in a row, is that when we hit the bottom? Yep. By the 14th trade, we were down about to 7, 8, 8, 1. So, okay, about 21% or so. And that's what you expect with some of these swings. But over time, it's still profitable. Now, I keep the same success rate of 85, 86%. I keep the same target, 14, 15% range. Okay, let's call it 15% in this case. And I allow the losses, this is 84 to 16. Let me jot that down real quick. All right. But I allow the losses to go up to 65% of what I invested in the trade. At one point, we're almost down 50%. We still do have a profitable portfolio, but only about 18%, as opposed to the high numbers we just saw when we controlled the losses to 50%. Now, let's allow it to go to 75. 82 and 18. I'm right 82% of the time, and over time, I'm at a massive loss of 70%. See if we can get to 84. Where we were 84. Okay, 85, 15, let's take that. I allow the losses to go to 75%. I'm right 85% of the time. At one point, thought I had a winning portfolio, up maybe 50% of where we started. At one point, we were down 56%, and we end with a loss even with an 85% success rate. This is key. This is extraordinarily key, to manage the losses and keep it to 50% to be successful with these strategies, these leverage strategies long term. Now, Victor brought in a question, but when you close at 50% loss, you will close and lose more often than the probability of loss. No. What we've seen and what we've traded ourselves, Victor, is that a 50% loss is a significant decline when you're doing an 85% probability bull put spread. You're starting 7 to 8% of the money. The stock has to fall 6 or 7%. What we found is in all the testing and in all the trading that we did over the time period to develop the approach for this is that changing to the 50% loss didn't mean we closed more. If we allowed it to go to 75, we still lost 15% of the time and still were right 85% of the time. A lot of investors asked me over the years when we've been talking about these positions and these structures, they say, well, shouldn't you be taking profits at 50%? And that didn't work either. For what the targets we'd set up and the structures that we've done, the stops that we've put in the trading, if I keep the 50% target loss on the spread, Victor, but lowered the gain down to 7.5%, I'm still losing money even with an 88% success rate. I don't close the short-term out of the money credit spreads early at all. I go for full expiration or at least 90% of that 50% target. The controlling the loss to 50% is key. And during the bull markets that we've seen from 2016 to the end of roughly, hiccups in between, the end of 2018, when the SPY dropped below the SMA 20, we wouldn't be entering bull put spreads. We'd be entering bear calls. We were following the trends, as Jim mentioned earlier and Chuck mentioned last week. So by setting the 50% loss, we are still able to keep the 85, 86% success rate. We're just not letting these losses go to that 70% rate where you saw this cut in half or 75%, with the same profit values and same things along those lines would have put you into a negative. That's still how it worked, Victor. It didn't increase the number of losses by setting a 50%. Now, if I set the loss limit too low, Victor, if I set it at 35, if I set it at 25% of the maximum loss, yes, I would not have an 85, 86% success rate. We'd probably be at, I want to say 72 to 75, somewhere in that range. Let's just see. Let's put this at 25 loss and then 25 as well. Say 75 on the high end. I think it'd be less than that. And see, that's still profitable in that case, but I really think it's lower than this. I think it's, 28 or 30, somewhere in that range, probability of loss. Yeah. So I can't remember what my exact numbers are. I'll look that up for you later, Victor, and send you an email regarding that. But that just sort of illustrates the importance here in this case of why you want to use a 50% stop on these spread positions. Now, what about the 30-70? Let's go ahead and put that in. So 30%, I'm sorry, not 90, folks. 30% target return. Let's say that I control the loss at 50 and my probability of loss is 30. So I'm looking to be right 70, 72% of the time. I'm going to make 30% when I'm right and control my losses to 50. This should be huge positive expectancy. I'm going to get closer to 70 here. There we go. This should be huge positive expectancy. But again, because I'm only starting 3 or 4% of the money in comparison with a 70% probability as opposed to 7 or 8% out of the money with an 85% probability, you couldn't control that. I'm sorry, you couldn't control the loss to 50. It was closer to, let's call it 68. It was between 65 and 70. 72% winners. Still down about 28%, 27% on the portfolio in that case. 69, yeah, it's terrible. 37, you're bankrupt. So we didn't even get there. 71, down 50%, and so on and so forth. Okay? All right. Oh, that's a great point, Mark. And Chuck, too. So Mark says, for weekly strategies, and that's what we were kind of looking at here on the bull put credit spreads. Let's see if we have the same results there, the preferred ones in that case. Mark says, for weekly strategies, the probability of touch and the probability of loss may be similar, but for monthlies, the probability of touch becomes more important. It could prompt you to take management out of loss too early. That is a great comment. So that kind of goes along with what Victor's saying. With using the weeklies here, I'm looking at the probability above. I'm not looking at the probability of touch, but at a shorter term. If this was a monthly trade, Victor, and I look to stop the position because the probability of touch, the probability Monte Carlo calculation that the stock would ever touch the strike price in the next 32 to 33 days, that's going to be much higher than the static probability above. On a monthly, it becomes more important because it's got more time to move against you, is kind of what Mark's saying, and it's a very important thing to use. So that's also something to keep in mind, which might, Mark maybe brought that up, Victor, to point out on my comment saying that it did not increase the number of closed positions by using the 50% stop. However, if I use a stop based on the probability of touch on a monthly position, or even as a weekly position or 2 weeks out in time, if I'm using that as a trigger, it might be triggering more often, which would affect, as you mentioned, the expectancy of profit. Chuck mentions, I always enter a closing order on my credit spreads with a buy back my spread at 1 cent. Tastyworks doesn't charge commission to close orders, so I'm only giving up 1 cent of profit. It's amazing how frequently I get filled and the market goes the other way. That's fantastic. And remember, Chuck's approach, he was using weekly spreads where he was looking for 1% per day. We don't know if he's using 2 or 5 point spreads. It could vary, of course, depending on what stock he's looking at, or underlying security if he's using SPX, for example. But he's looking for that 1% return per day, 5% per week. So if it continues the trends, you probably had some good bull put credit spreads this week, Chuck, where on that third and fourth day of Thursday, moving into Thursday, it was still going, even somewhat this morning. I bet many of those bull puts that you had in for this week probably got closed at that 1% profit. I'm sorry, 1% closing price that you had mentioned, where you got 99% of the expected profit before expiration, before the market turned at, what was it, 11 o'clock this morning, something like that. I'm sorry, Chuck. Chuck's down under, of course, folks. I keep forgetting to mention that. So they all closed for him while he was sleeping. So he got all the profits on those positions, the spreads that he was doing for this week. And they probably closed, as I mentioned before that. Victor, I'm not going to delve too deeply into this right now. In that case, Victor says, so on monthlies, you would take most of the profit or even 50% and close early if it hits. Yes, absolutely. More along the lines of 80% expected profit. On the shorter term trades, I'm looking for at least 90% or as much as possible, as Chuck just mentioned. And these are still talking about out of the money credit spreads with a higher probability, still going out for a monthly position. Let's do the initial values here. So on this position, still a 75% probability. Burlington Coat Stores at 156. 14 points out of the money, selling the 142 put and buying the 140. Net credit of 58 cents and 143 for a 28-day trade. If I can close this position, and I take in, let's say I take in 60 cents. If I can close that for maybe 20 cents only and keep 40 cents or 2/3 of what I expected to make in the first 5 or 10 days, I may take that off the table, Victor. You're absolutely right. But for the weeklies, I'm looking for the full return to keep my targets with that 15% or close to it average, 86% win rate as well. Now, if you're talking about the approach, it's a slightly different approach, but instead of using out of the money bull put credit spreads with the higher probabilities, or in the money debit spreads with a higher probability, if you're talking about the at or just out of the money bull call debit spreads that have closer to a 1-to-1 risk reward ratio, so similar to a bull put, but instead of selling something that's below the stock price here, it's a parity trade essentially to a bull put, but with the bull call, investors like this 1-to-1 ratio idea, where here's Meta at 169.27. Ooh, took a 14-point hit today. We could sell, this is farther out than let's use this Ollie's bargain one, 65.58. We're essentially going to straddle the stock price here. I'm going to sell an out of the money 67.50 call that's far out in time, and at the same time buy a 65 call for the same 91-day out expiration to October. We're a 2.5-point spread, and my debit is 105 at midpoint. What does that mean? That means that if I place this trade, I got to pay a debit of 105. But if it stays above 67.50, then I can potentially get 250 back because I'm going to close the spread position out, essentially buy shares of stock at 65, sell them at 67.50, we get 250 back. So we're going to make a profit of 145, on an investment of 105. That's 138% return on the position. Investors use this at or out of the money approach longer term, Victor, with debit spreads only. You don't do this with a credit spread because if I sold the 67.5 put, which would be a parity, I'm starting in the money and I can be assigned any time. This is an out of the money call. We're above the stock price right now. We don't have any obligation to do anything. The allure of this approach, why go further out in time? It's because you're giving yourself more time for the stock to move in your direction. The allure here is you have closer to a 1-to-1 or a 2-to-1 risk reward ratio, or sometimes in this case, what are we looking at? We're looking at a 1-to-1.5 risk to reward ratio. We're almost making 40-50% more than the debit paid into the position. Investors who trade this approach it the same way. They will close the position if they get near a 50% loss. In other words, if the stock falls and the liquidation value of both options is below 52, 55 cents, they're not going to let it go to full loss. You can't do that. But on the same side here, if the profit gets to 70 or 75, half, 50% of the maximum return, they're going to close the position early, and they're still going to have a 60, 70% profit on the trade of the position. So with that approach, it is more common to close the position early. With shorter term trades, as Chuck mentioned, with the weekly spreads, close if you've got 95, 99% of your expected, and he doesn't pay commission costs to close it, so that's fantastic at Tastyworks. And I will look to hold mine too with the shorter term trades, the 1 week or 2 week out trades, so that I can get the profit that I want on the position as well.